Can you really trust AI with your money? Imagine handing control of your trading account to artificial intelligence. No emotions, no panic selling, no fear of missing out, no sleeping. The AI watches the market 24 hours a day, analyzes thousands of data points, and enters trades within milliseconds. It sounds like the perfect trader, but would you actually trust it with your money? Artificial intelligence is rapidly changing finance. Trading platforms now promote AI-powered signals, automated bots, market predictions, portfolio analysis, and risk management tools. Some people believe AI will eventually become better than human traders. Others believe it could help investors lose money faster than ever before. So, how reliable is AI when real money is on the line? One of the strongest arguments in favor of AI is that it does not experience emotion. Human traders panic. They become greedy. They chase rising prices because they fear missing out. They hold losing positions because they do not want to admit they were wrong. They also become overconfident after a few profitable trades and begin taking risks they would normally avoid. An AI trading system does not feel fear, excitement, exhaustion, or desperation. It follows instructions. When the strategy says buy, it buys. When the risk limit is reached, it closes the position. That level of discipline could make AI more reliable than many individual traders. But there is a problem. AI systems are still designed, trained, and controlled by humans. The machine may not have emotions, but the person who created the strategy certainly does. A developer can choose poor quality data, make unrealistic assumptions, ignore trading fees, or build a system that performs well only under specific market conditions. This can create something known as overfitting. Overfitting happens when a system becomes extremely good at explaining historical market movements, but fails when it encounters new information. The results may look incredible during testing. The bot might show massive returns, a high win rate, and very few losses. But it may have simply memorized patterns from the past. Once real money is involved and market conditions change, the strategy can collapse. A perfect backtest does not guarantee future profits. Sometimes, it only proves that the system is very good at predicting something that has already happened. Still, AI has one major advantage that humans cannot easily match: scale. A person can study a limited number of charts, economic reports, news articles, and technical indicators. An AI system can potentially analyze price movements, trading volume, volatility, interest rates, economic data, social media sentiment, blockchain activity, and relationships between multiple assets at the same time. In cryptocurrency markets, this becomes especially attractive. Crypto never closes. Bitcoin, Ethereum, and thousands of other cryptocurrencies trade 24 hours a day, 7 days a week. Prices can rise or collapse while you are sleeping. An automated system does not need rest. It can continuously monitor prices, stablecoin flows, exchange activity, market liquidity, whale transactions, and changes in trading volume. By the time a human notices something important, the AI may have already identified the pattern and reacted. But speed is only useful when the decision is correct. An AI system can make a bad decision much faster than a human. Cryptocurrency markets contain manipulation, fake news, low liquidity tokens, coordinated promotions, fraudulent projects, and sudden liquidations. Suppose an AI system detects a huge increase in online conversations about a cryptocurrency. It may interpret that activity as strong investor interest. But what happens when those conversations are being generated by bots promoting a pump-and-dump scheme? The AI could buy based on artificial hype, only to become exit liquidity for the people behind the promotion. More data does not automatically create better judgment. Sometimes, it simply creates more opportunities for the system to be misled. This is why AI may be more valuable as a risk management tool than as a prediction machine. An AI system can calculate position sizes, monitor portfolio exposure, establish stop-loss levels, and reduce risk when volatility increases. It can also prevent traders from making impulsive decisions. Imagine Bitcoin drops 10% in only a few hours. A human trader might panic, sell everything near the bottom, and then buy back at a higher price when the market recovers. A properly designed system could continue following a predetermined plan. It might reduce the position gradually, hedge part of the portfolio, or remain inactive if the decline is still within the strategy's expected range. AI does not need to predict every market move correctly to be useful. It may simply need to manage mistakes better than humans do. The concern, however, is that most ordinary investors do not understand how their AI trading system works. They see an advertisement promising an 80% win rate, guaranteed returns, or passive income while they sleep. They deposit their money without examining the strategy behind those claims. But a high win rate can be extremely misleading. A system could complete 8 small profitable trades and then lose everything on the 9th. Some trading bots also use dangerous methods such as excessive leverage, martingale strategies, or repeatedly buying more of an asset as its price continues falling. These strategies can appear profitable for weeks or even months. Then one extreme market event destroys the entire account. The bot does not recognize that your rent money, emergency savings, or retirement funds are involved. It simply continues executing its instructions. This does not mean AI trading should be avoided completely. The technology can be tested, monitored, and controlled. Investors can use paper trading before risking real money. They can establish maximum daily losses, restrict position sizes, disable leverage, and require human approval before major transactions are executed. AI does not have to replace the investor. It can serve as a co-pilot. The system can identify patterns, calculate probabilities, organize information, and suggest potential trades. The human can then decide whether the opportunity makes sense within the broader economic and market environment. That combination may be more effective than either humans or machines operating completely alone. Because the greatest danger may not be artificial intelligence itself. The greatest danger is blind trust. AI does not know the future. It cannot guarantee that a company will succeed, that inflation will fall, that interest rates will change, or that Bitcoin will increase after a major event. It generates conclusions based on the data, assumptions, and instructions available to it. When something unexpected happens, a regulatory decision, an exchange collapse, a war, a recession, a security breach, or a sudden liquidity crisis, the historical patterns the system relied on may no longer apply. A strategy that performs well during a bull market may fail during a prolonged downer. A system designed for stable conditions may collapse during extreme volatility, and the AI may continue following its model even after the market has fundamentally changed. So, is AI reliable for trading? Yes, but only within limits. AI can analyze large amounts of information, automate repetitive tasks, enforce risk controls, and reduce some emotion-driven decisions. But it should not be treated as an independent machine that can predict every market movement and generate guaranteed profits. Its reliability depends on the quality of its data, the strength of its strategy, its risk controls, and the market conditions in which it operates. The smarter question may not be, can AI predict the market for me? The smarter question is, how can AI help me make more disciplined decisions without giving it unlimited control? Before using any AI trading system, understand the strategy behind it. Test it without real money. Study its largest losses, not only its biggest profits. Avoid systems that promise guaranteed returns. Limit leverage. Set strict risk controls. And never invest money you cannot afford to lose. Artificial intelligence may become one of the most powerful tools in modern finance. But even the most advanced machine cannot eliminate uncertainty. And in trading, uncertainty will always be part of the price. Would you allow an AI system to trade your money? Or should artificial intelligence remain a tool while humans make the final decision? Share your opinion in the comments. Subscribe to Find Encrypt for more videos about cryptocurrency, investing, technology, and the future of money. This video is for educational and informational purposes only. It is not financial advice.